So how do we handle this risk? Well, that's what I want to talk about here. I'm going to relate it to my professional experience. That when we use buzzwords like that, you should start getting scared probably. A medical doctor once told me that when a medical doctor says, in my clinical experience, that means he's had one patient. When he says in case after case, that means 2. And when he says cases too numerous to mention, that means 3. I have had a lot of professional experience. I've worked for an investment firm for quite a few years. While I was a professor, I was a principal in an investment management firm. I did a lot of consulting for a Bank of New York in Manhattan. But the primary experience that I'm really drawing on here, it started in 1986 when an attorney called me up and said, do you know anything about options? And I did teach about options. I said, sure. And he said, would you testify in a trial, an arbitration, a securities litigation, as to whether the options in this portfolio were appropriate for this particular situation, which was a pension fund. They were buying options for a pension fund. So I testified that in 1986, and then the stock market had a crash in 87. It seemed like a crash at the time. Had a crash in 1987, and there was all this litigation. And I got involved over the past maybe 20 years of being involved in probably 200 litigations as an expert witness. And I feel kind of like a doctor who's in an emergency ward, in a war zone, or in an inner city or something like that, where you see everything that can be done wrong. And it's devastating. And I see people that made so many mistakes, and I've seen the devastating consequences to it. From people that were in retirement and had to come out of retirement and become a Walmart greeter. Nothing against Walmart greeters. It just wasn't what they planned on for their retirement. To even one of the saddest cases was a big guy, and he was literally crying that could we somehow get his money back, some of his money back, could the attorney do it, before his wife found out, because he was certain his wife would leave him if his wife found out what had happened to their retirement savings. And I hope you listen to some of the things that I talked to you about today, but one of the things I want to emphasize is if you're married, is to talk with your spouse. I urge you to do it as a team, that the two of you agree on the big picture of what you're doing with regard to investments. And I can't urge that strongly enough. I'm going to be a little sexist about this and say that I think most men think they're the smartest person that ever walked the planet sometimes, and we get it into our head that we're going to be able to take some risks, and we're going to be able to beat everybody else and do well, and the women that are with us know that we're not the smartest person that ever walked the planet, so they tend to moderate our advice a lot, and in some relationships it might be the opposite. But I urge you to do this as a family unit, whatever the unit is. If somebody else's life depends on your decisions, have full agreement about the sort of issues that I'm about to talk about. But hopefully you'll agree with me with some of the things I'm talking about. Let's get in. What do I mean by modern portfolio theory? Well, I won't get over technical about this, but it really started in the 1950s when a guy named Harry Markowitz, who taught at Baruch in New York City and won a Nobel Prize, began to talk about risk and return not in broad qualitative terms, but he used math and statistics. And it put the discussion in such a rigorous framework that was the birth of modern portfolio theory, the way I'm describing it. In the 1960s, they invented a model, the capital asset pricing model, which is really what I'm going to rely a lot on today, about how one ought to invest. And another theory that was invented in the 1960s is the efficient markets hypothesis, especially by Eugene Fama. Most, if not all, of the people involved in this won Nobel Prizes. And that hasn't impressed me lately who wins Nobel Prizes, but anyways, I'm impressed with this theory. And what this theory says, and this theory is based on a lot of very unrealistic assumptions. It assumes there are no transactions costs. It assumes that every asset in the world, even my watch, it's not an expensive watch here, but even my watch can be owned by anybody. So it assumes that every asset in the world is traded, and that it's traded without transactions costs. That Walker could own 1/billionth of a share in my stock, and somebody else could own more shares, and they could trade them back and forth without any costs. And those are, of course, ridiculous assumptions, but that's how they developed this theory. And based on that theory, they say that all people should simply invest in two assets, or two portfolios, if you will. One is a portfolio, I'm going to go to the second one here first, of what we're going to call the risk-free asset. It's not really risk-free, but it's very, very short-term, very low credit risk investments, such as money market accounts, money market mutual funds, treasury bills, very short-term FDIC certificates of deposits. Ultra-safe money. And then the only other place you should put your money is in a fully diversified portfolio that I'm going to call occasionally the market portfolio. And what's in there? Everything is in there. It's fully diversified. It's as diversified as you can get. Now, in a minute or two, I'm going to start to really flesh out, and I hope, real actionable detail what I mean by investing in these two assets. But the capital asset pricing model says that's the only two things you need to invest in. What about the proportion of how much money you ought to put in these two things? Well, the capital asset pricing model doesn't tell us a darn thing about that. And that's a big question, but that's a very person-specific issue. It's like me trying to tell you what your favorite fruit is or what your favorite ice cream flavor is. It's just, I don't know. It's really based on personal preference. I manage money for quite a few family members, and this is one thing that I will pick these, that's no problem, but I will not pick this for them. I make them pick that. I wouldn't let them make a stupid decision. But if you put all your money in the risk-free rate, it's going to be safe, but you're not, on the average, in the long run, going to even keep up with inflation hardly after taxes. If you put all of your money in the stock market or the market portfolio, you better be prepared to lose possibly 50, 75, 90% of it over non-trivial lengths of time. So how do you make that decision? Well, I'll talk very briefly about that right now, the proportion of each. And there's an adage which says to invest your age in bonds. So in the context of this model, I'm 54 years old. That would say to put 54% of my money in the risk-free asset and only 46% of my money in the stock market or a fully diversified equity portfolio. Now that's a prescription that we need to take with a real grain of salt. It isn't taken into account that I'm a tenured professor who has a reliable source of income. It doesn't take into account whether I have savings already accumulated, whether I'm a person who just doesn't spend much money, which is the truth, or whether I'm a person who has buys Ferraris all the time, has that sort of lifestyle. It doesn't take into account my makeup, my tolerance for risk. How upset would I be if I lost some money? So all those other things need to be brought in, but a starting point is to invest your age in the safe portfolio. So if I were 22 years old again, I would put 78%, maybe even 100% of my money in risky assets if that's retirement money that I know I'm going to leave there for another 50 years or so. I remember when I graduated University of North Carolina, Chapel Hill in 1981, one of the first decisions they asked me to do was you have to pick through your payroll office what percentage of your money you want to put in which of the retirement funds. And this was TIA CREF, which is what most academics' retirement plans are done in. And back then, there were simply two funds. TIA, which stood for an annuity fund, very safe, and CREF, which College Retirement Equity Fund, which was the stock market portfolio. And you really just pick between those two choices. Now, I had a PhD in finance, and I had no clue as to how to make that decision. No clue. My education was all about math and these abstract models. I had no clue as to how to make this. I was kind of embarrassed about that, but I needed to make the decision. So I went around to all the other finance professors at Penn State University, and I knocked on their door, and I said, I've got to fill out the TIA CREF paperwork. Could you tell me, do you think I ought to put my money in TIA, the annuity, the safe annuity, or CREF, the equities? And every one of them said the same thing. I don't know. I put 50% in each. And that's exactly what I did. I just put 50% in each. We had become a little bit more refined in that. And we began to think in terms of ages. And if you're really young, maybe you could put almost all of your retirement money in the stock portfolio. And if you're super rich like Bill Gates, maybe even at retirement, you could put all of your money in a risky portfolio. But generally speaking, especially when we pull the trigger that we're going to retire or we have retired, we want to keep thinking about putting a non-trivial amount of money in a safe